Imagine, for just a second, that you are tasked with building a city.
Okay, a city.
Yeah, but not just any city, right? You have to build a metropolis the size of New York.
Right.
Complete with like a perfectly functioning power grid, a flawless plumbing system, and literally billions of traffic lights that never ever fail.
Sounds impossible.
Right. But here is the kicker. You have to shrink this entire massive complex city down to the exact size of a postage stamp.
Wow. I mean, the precision required for that is just staggering.
Exactly.
You are essentially engineering at the atomic limit at that point. And the fascinating part is this isn't science fiction.
No, it's really not.
This exact architectural miracle is happening, billions of times a day all over the world, right inside the silicon that runs our modern economy.
Exactly. That microscopic city is, well, it's the AI chip powering the chatbot you used this morning.
Yep.
It's the processor rendering the video you streamed last night. And today we are tearing into the financial and operational mechanics of the only construction company authorized to actually build it.
It's going to be a good one.
Welcome to this deep dive. If you follow our Talk Tickers format, you already know the mission, right? We are taking a dense, highly technical Wall Street earnings call and distilling it down.
Translating the jargon.
Exactly. Distilling it into a data-forward, actionable briefing for retail investors. Today, we're analyzing the architects of the semiconductor revolution, Synopsys.
Ticker symbol SNPS.
That's the one. We are dissecting their second quarter fiscal year 2026 results. So we'll cover the headline numbers, the underlying structural story driving those numbers, management's forward-looking guidance.
Which is really interesting this quarter.
Oh, massively.
Oh.
And finally, our bottom line thesis on the stock. So buy, hold, or sell.
And, the context for this quarter is just crucial. We are in the middle of this massive architectural shift in how compute is basically generated.
Yeah, totally.
Everyone looks at the companies stamping out the physical chips, right? Like the foundries or the designers just putting their logos on them.
Right, the consumer-facing names.
Exactly. But the reality is the margin for error in modern silicon is literally subatomic.
Yeah.
You drop a microscopic skyscraper in the wrong spot, or a tiny power line crosses a tiny data pathway, and boom, the multi-million-dollar data center just grinds to a halt.
It's wild to think about.
The physical laws of the universe are literally fighting back here.
Okay, let's unpack this.
Yeah.
Because when you talk about the AI revolution, everybody instantly points to, NVIDIA or AMD.
Of course.
But Synopsys is operating on a fundamentally different level. They provide the electronic design automation, or EDA.
Right, the EDA.
And the foundational intellectual property blocks, the IP, that make designing sub-2 nanometer silicon physically possible in the first place.
Which is basically black magic.
It really is. But before we get into the physics of gate all-around transistors and multi-physics simulation, we really have to start where the market starts.
The income statement.
Exactly, the income statement.
Right, because a pure data-forward approach kind of strips away the hype, It shows us the operational reality.
Absolutely.
And the headline for Synopsys this quarter is just an absolute beat across the board. It demonstrates a level of operational discipline that is incredibly rare for a company undergoing such a massive technological pivot.
Yeah, so let's hit the specific Q2 data. Revenue came in at $2.276 billion.
Which exceeded management's own guidance, by the way.
Exactly. And then non-GAAP earnings per share hit $3.35, which also beat guidance.
Huge beat.
But the metric that fundamentally shifts the valuation model, for me personally, is the non-GAAP operating margin.
Oh, yeah. The margin is the whole story.
They hit 39.5%. I mean, in the enterprise software world, a near 40% operating margin isn't just a sign of a healthy business.
No, not at all.
It is a structural indicator of absolute pricing power.
That 39.5% margin is essentially a neon sign for institutional investors.
Right.
It proves that Synopsys has crossed this threshold where their R&D amortization and cost of goods sold are, they're flattening relative to new revenue generation.
Meaning they aren't just selling more software to hit higher top-line numbers.
Exactly. They are extracting significantly more profit from every single dollar that enters the ecosystem.
Wow.
When you see that kind of operational leverage in a dominant software as a service business, it tells you that their customers have literally no alternative.
You just have to pay up.
Right. They are paying the premium because the cost of not using Synopsys is catastrophic failure at the foundry.
It's the ultimate toll booth.
Truly.
But as impressive as the revenue and margins are, the most critical data point from this entire call, the number that guarantees the longevity of this financial model, was the backlog.
The backlog is insane.
Synopsys ended Q2 with an $11 billion backlog. And I really want to be clear about what that actually means, because I think people often misunderstand software backlog.
Oh, constantly.
This isn't just like a line of enthusiastic customers waiting to buy a product. It's a captive ecosystem.
Precisely, because under ASC 606 revenue recognition rules for software, that $11 billion represents remaining performance obligations, or RPO.
Right.
It is contractually committed, non-cancelable revenue. It's locked in.
Exactly. Let's think about the mechanics of this for a second. Let's say a hyperscaler, like a Google or an Amazon, they commit to a $500 million EDA contract over 3 years.
Okay.
They aren't just buying software, right? They are locking themselves into an infrastructure.
Right, it's foundational.
If they decided to switch EDA platforms halfway through designing a custom AI accelerator, it would delay their chip tape out by at least 2 years.
Easily 2 years.
And in the AI arms race, a 2-year delay costs billions in lost market share and compute efficiency. So that $11 billion backlog isn't just future revenue. It is uncancelable gravity.
That's a great way to put it. It's a massive financial shock absorber. If the broader economy takes a dip next quarter, or if hardware consumer spending slows down, Synopsys doesn't panic.
They just keep going.
Right. They simply continue working through the recognized revenue of that $11 billion fortress. It insulates management from short-term market volatility and basically allows them to make structural, multi-year strategic decisions.
Right. So the headline numbers are historically strong. We've got a clear beat on the top and bottom lines, elite software margins approaching 40%, and this $11 billion safety net.
Yep.
But numbers only tell you what happened. To understand if this growth is structurally sustainable, we have to transition to the actual engineering reality.
Our real story.
Exactly, the story behind the numbers. And to do that, we have to look at the dual engines of their business model: design automation and design IP.
Let's break down the EDA side first, I think.
Sure.
The Q2 data shows EDA revenue grew slightly over 8% year over year, which on a multi-billion-dollar base, that is highly robust growth.
Oh, yeah.
But the why behind that growth is deeply tied to the absolute limits of Moore's law.
This is where it gets so fascinating to me. We all know the baseline, right? EDA is the software engineers use to design the logical flow, place the components, and route the billions of microscopic wires on a chip.
The basic blueprint.
Right. But the game has fundamentally changed. We aren't just shrinking 2D transistors anymore. We are moving into sub-2 nanometer territory.
It's a whole new world.
The foundries are shifting from FinFET transistors to gate-all-around, or GAA architectures.
And this shift is exactly why Synopsys is experiencing such sticky revenue. In a gate-all-around transistor, you are literally stacking silicon nanosheets on top of each other.
To maximize the surface area, right?
Exactly, to maximize the surface area for the electrical gate. The complexity of routing power and data to these 3D nanostructures is just beyond human cognitive capacity.
You just can't do it by hand.
No. A team of human engineers cannot physically route 100 billion transistors using traditional standard cell methodologies.
And that's where Synopsys' AI-driven design tools come in, right?
Yeah.
Because it's not just a digital drafting board anymore.
No, not at all.
It's essentially a reinforcement learning algorithm that explores the design space to find the optimal placement for billions of components.
Precisely. The EDA software runs billions of simulations, placing and replacing components, constantly trying to minimize power consumption and maximize clock speed without creating thermal bottlenecks.
Wow.
So that 8% growth in EDA is a direct reflection of chip makers desperately needing this algorithmic horsepower to solve the pure geometry problem of 2-nanometer physics.
Yeah, which makes total sense.
Yeah.
But we have to talk about the other half of the business.
The IP segment.
Right, the design IP segment. And honestly, this is where I really have to push back on the broader bullish narrative.
Oh yeah, let's hear it.
The data from the call shows Q design IP revenue was $454 million. But management explicitly noted this was down approximately 6% year over year.
Right, it was down.
I get that they are transitioning from merchant IP to custom hyperscaler engagements, but if this transition is so seamless, why are we seeing a year-over-year contraction in the segment revenue?
It's a fair question.
I mean, the sequential 12% bump from Q1 imply the bleeding has stopped. But taking a strategic retreat in the middle of the greatest hardware boom in history feels like, I don't know, a miscalculation on timing.
Yeah, look, it is entirely logical to view a 6% year-over-year contraction as a red flag.
Right.
Especially, like you said, in a bull market for silicon. But To understand the sequential recovery, we have to look at the underlying financial mechanism of how IP is actually licensed and recognized.
Okay, explain that.
Synopsys is deliberately uncoupling from lower margin legacy consumer electronics. So things like standard microcontrollers for smart home devices.
They're just dropping them.
Yeah, to free up engineering resources for highly customized, bespoke silicon designs for the hyperscalers.
So you mean companies like Amazon building their Trainium chips or Microsoft building their Maya AI accelerator?
Exactly. Historically, Synopsys sold merchant IP, standardized pre-verified blocks like a basic USB or memory interfaces.
Like Lego blocks.
Right, standard Lego blocks. They sold them to hundreds of different chip makers on a standard flat fee licensing model. It was reliable, sure, but low margin.
Right, commodity pricing almost.
Exactly. The hyperscalers, however, they don't want standard blocks. They are optimizing their data centers for massive distributed AI workloads. They need custom silicon that maximizes data throughput and minimizes power per watt at a rack level.
Right, because if Amazon can shave, say, 1 watt of power off a custom chip, and they deploy that chip across 1 million servers.
The math is crazy.
Yeah, the operational cost savings in electricity and cooling are in the tens of millions of dollars.
And that right there is the crux of the transition. Synopsys' CEO, Sassine Ghazi, made it very clear on the call. They are migrating away from simple licensing fees.
Toward what?
Toward a model where they capture a percentage of that immense value they are enabling. They are actively negotiating structures that monetize the specific architectural advantages their IP provides to these massive data center buildouts.
Oh, I see.
So the short-term revenue hit was basically the cost of restructuring these contracts and shifting engineering focus. The 12% sequential growth in Q2 is the proof that the new, higher-margin hyperscaler contracts are finally beginning to hit the balance sheet.
Okay, so it's a strategic sacrifice of low-margin volume to secure high-margin, sticky enterprise value.
Exactly.
That makes mathematical sense. And the transcript gave us a massive data point that proves their foundational IP is still absolutely dominating the bleeding edge of the industry.
The PCIe number.
Yes. They highlighted their PCI Cs 7.0 IP achieved a staggering greater than 90% win rate this quarter.
Which is just wild. This is perhaps the most important technical metric buried in the whole earnings call.
Yeah, tell me why.
Well, PCIe, or Peripheral Component Interconnect Express, is the central nervous system of a computer.
Okay.
It's how the GPU talks to the CPU and how memory talks to the network interface. PCIe 7.0 is the absolute bleeding edge standard, targeting 128 gigatransfers per second.
And let's explain the physics of why that actually matters for a second. In an AI cluster, the primary bottleneck is no longer the raw math capability of the GPU, right?
Right.
The bottleneck is the memory wall. You have these massive large language models, terabytes in size, and you have to shuttle that data back and forth between the high bandwidth memory and the compute cores instantaneously. If your interconnect is slow, your $30,000 GPU just sits idle waiting for data.
Exactly. The speed of the interconnect dictates the efficiency of the entire multi-billion-dollar data center.
Which is terrifying for these companies.
It is. But achieving 128 gigatransfers per second requires pure physical black magic. You are dealing with extreme signal degradation, insertion loss, and the complexities of PM4 signaling,
Right.
which basically encodes 4 distinct voltage levels into a single electrical pulse.
It's an analog engineering nightmare.
It truly is. Designing the physical layer, the PHY, for PCIe 7.0 requires hundreds of specialized analog engineers and years of trial and error. A hyperscaler like Google or Microsoft does not want to spend 5 years figuring out how to push an electrical signal through a copper trace without it deteriorating into pure noise.
No, they want it now.
Right. It is infinitely cheaper and vastly less risky to simply license the pre-verified PCIe 7.0 IP block directly from Synopsys.
Which totally explains the 90% win rate. It's a monopoly on the fundamental physics of AI data transfer.
Essentially, yes.
And that naturally leads into the other massive IP metric they dropped, 150 lifetime wins for UCI.
Yeah, UCIe. Universal Chiplet Interconnect Express. It represents the actual future of semiconductor manufacturing because we've reached the economic limit of monolithic silicon design.
But break that down for the listener. So a monolithic die is the traditional way chips are made, right?
Yeah.
One giant contiguous piece of silicon with all the components etched into it.
Exactly.
But as chips get bigger, approaching the physical size limit of the lithography tools.
The reticle limit.
Right, the reticle limit. The manufacturing yield just plummets.
Right.
If you have one microscopic dust particle land on a massive monolithic die, the whole chip is ruined.
The economics become totally disastrous. The industry solution to this is the chiplet architecture.
Right.
Instead of manufacturing one massive chip, you manufacture several smaller, specialized chiplets.
Yeah.
And they have much higher manufacturing yields.
Because they're smaller.
Exactly. So you might have an I/O chiplet built on an older, cheaper 7-nanometer process and a compute chiplet built on an expensive 3-nanometer process. You then stitch them all together on a single advanced substrate package.
But the challenge there is making those distinct, separate pieces of silicon talk to each other as if they were one unified chip.
Right.
Because if the latency between the chiplets is too high, the performance collapses.
That is exactly where UCI comes in. It is the standardized die-to-die interconnect protocol. It allows chiplets manufactured by different foundries on completely different nodes to communicate seamlessly with sub-nanosecond latency. If an AI hardware company wants to mix an AMD processor with a custom-designed accelerator and package them together, they have to use UCIe.
And they own it.
The fact that Synopsys has 150 lifetime wins for this specific protocol means they own the foundational architecture of the chiplet era.
So just synthesizing this all together, their traditional EDA is locking in customers trying to navigate the 2-nanometer complexity wall.
Yeah.
Their IP division took a calculated dip to pivot to high-value hyperscaler contracts. And they have established a near monopoly on the critical data transfer protocol, so PCIe 7.0 and UCIe, that make modern AI hardware even possible.
That's the summary, yeah.
But there is one more piece to the operational story that we absolutely must cover. And honestly, it's the most aggressive strategic move Synopsys has made in a decade.
Oh, the Ansys integration.
Yes, the Ansys integration.
The pending acquisition of Ansys is basically the catalyst that transforms Synopsys from a digital software company into a comprehensive physical simulation empire.
That's a huge shift.
It is. They are expanding beyond the logical flow of a chip into the realm of multi-physics simulation.
I was looking to this Ansys integration, and it struck me that this is the ultimate admission that Moore's law, as we traditionally understand it, is dead.
Yeah, it's over.
It's no longer just a 2D math problem of fitting more transistors onto a flat plane. It's a 3D physics problem now.
Huh.
When you take those chiplets we just talked about and you start stacking them vertically, creating 3D integrated circuits, you are fundamentally trapping heat.
Oh, the thermal dynamics are terrifying.
Really?
Absolutely.
Yeah.
In a traditional 2D chip, the heat escapes from the top surface into a heat sink. It's simple.
Right.
But when you stack logic die on top of logic die, the heat generated by the bottom layer has literally nowhere to go. It gets trapped.
That sounds bad.
It leads to a phenomenon known as dark silicon. Entire sections of the processor that must be dynamically powered down to prevent the physical silicon from melting.
While melting. And it's not just heat, right? You have thermal crosstalk, where a hotspot on one chiplet interferes with the clock speed of a neighboring chiplet.
Yes, exactly.
You have mechanical stress from the coefficient of thermal expansion, meaning different materials in the chip package expand at different rates when they get hot, which can literally rip the microscopic solder bumps apart.
This is exactly why Ansys is so critical to their future. Synopsys' traditional EDA software makes sure the digital ones and zeros arrive at the right place at the right time.
Right.
But Ansys is the gold standard for finite element analysis. It mathematically simulates fluid dynamics, thermal dissipation, and structural integrity at a subatomic level.
Wow.
By deeply integrating Ansys solvers directly into the Synopsys design flow, they're basically offering a unified chip-to-grid solution.
Let's walk through what that actually means for an engineer on the ground. Historically, an engineering team would design the digital logic in Synopsys, export the design, and then run a separate thermal simulation.
A completely disjointed process.
Right. And if the simulation showed the chip would melt under load, they had to go all the way back to the digital drawing board, move components around, and try again. It was this iterative, incredibly time-consuming loop.
And what management highlighted on this call is a unified multi-physics fusion technology.
Which changes everything.
The engineer can now design the logical layout and simultaneously simulate the thermal and mechanical realities.
That's huge.
The software predicts how hot the 3D chiplet will get, how that heat will warp the substrate, and how the electromagnetic interference will affect signal integrity, all in real time. Management explicitly stated they're seeing up to 3x faster design closure with this integrated flow.
A 3x productivity boost in an industry where time to market is literally everything.
It's massive.
If you can shave 6 months off the development cycle of an AI accelerator, you save tens of millions in R&D and capture the market window before a competitor does. The ROI for the customer is undeniable. But here is the critical financial implication of this integration. As they fuse these capabilities, they are transitioning how they capture value.
Yeah, the CEO was very pointed about this part. He stated that in combining Synopsys and Ansys, 1 + 1 must be greater than 2.
Right.
They are not simply bundling 2 software licenses together for a slight discount.
Yeah.
They are creating a premium, unavoidable tier of physical simulation capabilities, and they intend to aggressively monetize the monumental cost savings they are providing to the hyperscalers and foundries.
So they built this massive operational leverage by dominating EDA, pivoting their IP to high-margin custom silicon, and integrating physical simulation with digital design.
The trifecta.
But that raises a profound question about their future capitalization. If this multi-physics approach is as revolutionary as they claim, and if the $11 billion backlog is as bulletproof as we believe, we should be seeing this aggressively priced into their forward-looking model.
We should.
Let's shift our focus to management's full-year 2026 guidance. Because Wall Street doesn't pay for Q2, Wall Street pays for the future.
And the future, according to this earnings call, is highly accelerated. Management raised their full-year guidance across every single meaningful metric, which is a really powerful signal of conviction in a macro environment that has plenty of other software companies guiding down right now.
Yeah, let's hit the specific projections. Full-year 2026 revenue guidance was raised to a range of $9.625 billion to $9.705 billion.
Right.
Full-year non-GAAP EPS was pushed up to a range of $14 to $14.80. Free cash flow was projected at roughly $2 billion.
Very strong.
But again, the metric we absolutely have to dissect is the margin. They raised their operating margin guidance by 50 basis points to an astonishing 41% at the midpoint.
A 41% operating margin target for the full year is a structural milestone. We discussed how their 39.5% Q2 margin proved their pricing power. Guiding for 41% means they see an accelerating path to profitability. They're fundamentally wringing more efficiency out of the core business engine quarter over quarter, while simultaneously funding massive R&D for the AI transition.
And they're achieving this margin expansion partly by actively pruning the business. The CFO, Sheila Glazer, detailed the upcoming divestiture of their processor IP solutions business.
Right. The divestiture.
They're selling off a non-core division, which will technically result in a $40 million hit to top-line revenue for the remainder of the year.
But that $40 million revenue reduction is actually a strategic positive.
Why is that?
Well, in corporate finance, you want management to ruthlessly allocate capital toward the highest return opportunities.
Right.
Holding on to a lower margin legacy processor IP division when the entire industry is shifting toward multi-physics AI simulation is a total misallocation of resources. Trimming that fat focuses the engineering talent and the sales force purely on the hypergrowth vectors.
Which brings us to perhaps the most fascinating corporate governance development discussed on the call. This relentless drive for efficiency and margin expansion isn't just happening in a vacuum.
Oh, definitely not.
Elliott Management, one of the most aggressive and successful activist investment firms globally, is now inside the house.
That was huge news.
Jesse Cohn, a managing partner at Elliott, was just appointed to the Synopsys board as an independent director.
The inclusion of Jesse Cohn basically validates the entire financial thesis we are building today. Activist investors of Elliott's caliber do not involve themselves with deeply established companies unless they have identified massive, untapped avenues for value creation.
Let's analyze the activist playbook here for a minute.
Right.
Elliott isn't there to tell Synopsys engineers how to write better simulation algorithms.
No, they don't care about the code.
The CEO explicitly noted that Elliott completely agrees with the essentialness of the Synopsys portfolio. They know the technology is a monopoly. Elliott is in the boardroom to enforce operational discipline. They were looking at the 41% margin and saying, given your absolute monopoly on the tools required for the AI revolution, your margins should be even higher. Stop underpricing your value to the hyperscalers and eliminate internal corporate bloat.
It is a ruthless pursuit of shareholder value, and we can already see the levers they're going to pull.
What are they?
The CFO specifically highlighted that Synopsys is only approximately halfway through their committed cost synergies from the Ansys acquisition.
Oh, that's interesting. Let's define the mechanics of a cost synergy for a merger of this scale. When a giant like Synopsys absorbs a massive entity like Ansys, There is inherent duplication.
Tons of it.
You have redundant HR software licenses, overlapping real estate footprints, duplicated middle management, and inefficiencies in cloud compute spend for R&D.
Exactly. And the cost synergy is the hard capital saved by ripping out those redundancies. The fact that management is publicly stating they are only 50% of the way through this integration means there's a massive tranche of structural overhead that will basically evaporate over the next 12 to 18 months.
Wow.
As those duplicate costs are removed from the income statement, that cash falls directly to the bottom line, artificially accelerating earnings per share growth, even if top-line revenue remains static.
So the 41% margin is just the floor.
Exactly.
They have activist pressure to optimize pricing and guaranteed margin expansion simply by finishing the Ansys cleanup. It's an incredibly robust setup for 2027. But, I noticed something deeply intriguing in the Q&A section of the call regarding how they actually modeled this guidance.
Oh, the Intel question.
Yeah. An analyst pressed management on the revenue pipeline building around Intel Foundry's massive new fabrication nodes, specifically the ATA and 14A processes.
This is a critical nuance regarding how EDA revenue is recognized.
Right. Because when a foundry like Intel spins up a next-generation manufacturing node, every single fabless chip designer who wants to manufacture on that node has to license new node-specific IP and EDA tools from Synopsys.
It forces an entire industry upgrade cycle.
Exactly. The analyst essentially asked, is the impending wave of revenue from Intel's new node factored into this raised $9.7 billion guidance? And the CEO's answer was a definitive no.
Fascinating.
They stated they only recognize and forecast the revenue when a customer physically transitions from the evaluation phase to actual production.
Which means this raised guidance is built entirely on the momentum of their current locked-in business.
Exactly. I have to ask, is management sandbagging these numbers? Are they intentionally excluding known, massive pipeline catalysts like the entire semiconductor industry migrating to Intel 18A just to set up dramatic earnings beats in Q3 and Q4?
Well, I wouldn't use the term sandbagging, as that kind of implies deception. In the realm of enterprise software accounting, this is just extremely prudent forecasting. You do not recognize pipeline revenue until the contract is signed and the performance obligation begins.
Right, that makes sense.
However, your underlying point is exactly how institutional investors model outperformance.
It's like an athlete breaking a world record and then casually mentioning they are running into a headwind.
Exactly.
Management has raised the full-year outlook based purely on the $11 billion backlog and the current hyperscaler transition. The uncounted pipeline of next-generation foundry node adoptions is a shadow catalyst. It represents billions in future revenue that simply isn't on the balance sheet yet.
When you aggregate the fundamental drivers, right, the Ansys cost synergies still to realize, the pricing power enforced by Elliott management, the structural transition to higher value custom IP, and the unforecasted wave of next-gen foundry adoption, you have a highly layered, remarkably de-risked path to sustained growth.
Which brings us to the ultimate synthesis of this deep dive. We have torn apart the income statement, analyzed the physical complexities of 3D chiplets and UCI interconnects, and unpacked the aggressive forward guidance and activist involvement.
We covered it all.
Now it's time to deliver the bottom line thesis for you, the retail investor listening to this. Based on the structural mechanics we've detailed today, how do we classify this stock?
If we look purely at the structural advantages, the insurmountable technological moat, and the accelerating profitability metrics, the definitive stance on Synopsys must be highly bullish.
I am in complete agreement. For any investor looking to allocate capital into the AI infrastructure space, SNPS presents a unique, fundamentally protected asset.
Absolutely.
If you are trying to pick the ultimate winner in the AI chip war, you are playing a dangerous game. You have to predict if NVIDIA's Blackwell architecture will maintain its dominance over AMD's MI300 series.
Right.
You have to guess if Google's custom TPUs or Amazon's custom Trainium chips will eventually render merchant silicon obsolete.
It is a market fraught with execution risk and hyper-competition.
Yeah.
But Synopsys is the great equalizer. They represent the ultimate picks and shovels play.
I love that phrase.
It fundamentally does not matter who wins the AI hardware war. Because to physically build any advanced logic chip, whether you are Jensen Huang at NVIDIA or a data center architect at Microsoft, you are required by the laws of physics to pay the toll to use Synopsys, EDA, and IP.
Sure.
They are the inescapable bottleneck in the global innovation pipeline.
Let's distill this into specific, actionable takeaways for the listener holding or evaluating this equity.
Number one,
The moat is impenetrable. You cannot replicate 30 years of proprietary electronic design automation algorithms, verified IP libraries, and ANSYS multiphysics simulation data overnight. The barrier to entry for a new competitor is effectively infinite. Number 2, the profitability matrix is structurally expanding. With a 41% baseline margin target, Elliott management actively scrutinizing internal efficiencies, and the back half of the ANSYS cost synergies about to hit the ledger, the company's free cash flow generation is heavily insulated.
And number 3, the business model transition is a long-term multiplier. While the pivot toward custom hyperscaler silicon created a momentary dip in legacy IP revenue, it is successfully transitioning Synopsys from a vendor of discrete software tools into a foundational, deeply integrated partner in global AI infrastructure. They are capturing a greater percentage of the final economic value of the data center.
Right. The $11 billion backlog isn't just an order book, it's an economic shield. In a volatile macro environment, owning the monopoly provider of the tools required to build the future of compute is as close to a fundamental portfolio anchor as you can find.
The durability of their ecosystem is the defining characteristic here. This isn't a speculative software wrapper built on top of an LLM.
No, not at all.
It is the absolute physics-based reality of how the modern world is actually constructed.
Before we close out this analysis, there was one final, frankly mind-bending concept introduced by the CEO during the Q&A session that I want to leave you with.
Oh, this is good.
It speaks to the ultimate evolution of this company. He discussed the implementation of agentic AI within their EDA platforms.
It is a glimpse into a recursive future that basically forces us to rethink software economics altogether.
Historically, the Synopsys business model has been bound by human limitations. They sold a software license to a human engineer.
Right.
That human sits at a workstation, inputs parameters, runs a simulation, analyzes the output, and adjusts the design. But the CEO noted a fundamental shift. They currently have 20 major customers actively evaluating automated solutions across 25 specialized AI agents.
Incredible.
They are rapidly moving toward a paradigm where autonomous AI bots, agent engineers, are the entities operating the Synopsys software.
And the economic implication of that shift is profound.
Tell them why.
The CEO explicitly mentioned that as these AI agents take over the design flow, Synopsys must transition its pricing model. They are moving from a traditional static subscription license for a human user to a subscription plus consumption model for these AI agents.
And this is the exact mechanism I want you to analyze as you evaluate the long-term compounding potential of this stock. Think about the physical limitations we just discussed. What happens to the revenue generation and the operating margins of an inescapable software monopoly when the engineers consuming the product are no longer humans?
Right.
An AI agent does not sleep. It does not take weekends off. It works 24 hours a day, 7 days a week, consuming massive amounts of cloud compute, running millions of micro-simulations, and constantly burning through consumption credits inside the Synopsys ecosystem.
If the underlying pricing structure shifts to consumption-based metrics in a world populated by tireless AI design agents, the historical ceiling on their revenue potential effectively evaporates.
Just gone.
It becomes a pure function of total global compute allocated to chip design.
It is the ultimate recursive loop. AI models designing the complex silicon hardware required to train the next generation of more powerful AI models, with the entire automated process happening inside and paying tolls to the Synopsys multi-physics ecosystem.
It's wild to think about.
We started this deep dive by talking about building a microscopic city on a postage stamp. The tools are ready, the blueprints are drawn, but now the cranes and bulldozers are learning to drive themselves.
Absolutely.
Thank you for joining us on this deep dive into the invisible architecture of the AI hardware revolution. Keep analyzing the data, understand the underlying mechanisms, and we will see you next time.